right, what about a bonus section? I thought it would be beneficial to you guys to actually go through some charts and look for bullish momentum breakouts, bearish momentum breakouts, and some consolidations. So this is the bonus section for you. We're going to go over the major markets. So we're looking at the SPY, the QQQ, and the DIA. This is the S&P 500, the NASDAQ, and the Dow Jones. And then we might throw in another ticker. But let's go hop into some charts and we will literally go through this together. So guys, before I created this video, I did not come in and look at these charts at all, but I want to do it here with you, as if I'm going through the chart itself. So let's look at it. First off, it's a 1 day, 1 year chart. So each candle body represents 1 day, and the time frame that we're looking at is 1 year's worth of time. We're going to look for bullish momentum breakouts, bearish momentum breakouts, and consolidation periods. But let's start with it. So we'll see here that it was at the beginning of the chart, it was in some consolidation period, meaning it had some lows, it had a high that was pretty at the top of that big red candle body. And then it had another low that was right here. Wasn't until it breaks this high that we start seeing a breakout. So let's chart that right here. Let's see, was on this candle body, which let's see if we can't zoom in a little bit. So on this candle body right here, it breaks above this high of the channel, and also the 10-day simple moving average is crossing above the 20-day simple moving average. So the start of that channel is right about here, and we would draw this thing out, and it continues to use the 50-day simple moving average all the way up to that about that point, and then it stays in that channel. So if we're here on this date, which is where it starts, we're not going to know the high of this channel until it hits a high and then comes back down lower. And then we'll see it hit another high and then it comes back down lower. And then we'll see it hit another high and it comes back down lower. The important thing to note here is that when there is momentum in a trend, that if it's a bullish trend, it will have higher highs and higher lows. Just like this. So we have a higher high here and a higher low because the previous low was around here. Then we have a higher high here and a higher low. Then we have a higher high here and a higher low. So that's a bullish. We'll have higher highs, higher lows, and the reverse is true for bearish, that we have lower lows and lower highs. That's whenever you see momentum in it. And an important thing to note about a trend line that's vertical or going at a slant is that it needs to have 3 points of contact for it to be a confirmed trend line. So we have about 1, 2 right here, and then there's a third one, and that shows us our fourth point up here. So at that point of this third point, we could draw out a trend line and say it should come up to this price point in the future. And sure enough, what happened? It did exactly that. So we have a bullish momentum breakout here whenever it came out of the consolidation period and it closed higher than the consolidation period. We have the breakout, then the 10-day crossing above the 20, and the price is above the 50-day simple moving average. We would enter into this trade on this day, and we would exit whenever the price closes beneath the 10-day simple moving average, or whenever we have a red candle body that engulfs the low of the previous day. So let's look at an aggressive exit where we have a red candle body closing beneath the low of the previous day. That would obviously be on this candle body here. So we might not make any money from entry point to that candle body, might even lose a little bit. But let's give it another go. It goes sideways, and we want to see it break above the highs. Here it breaks above the highs. We'd enter in here on this day. When would we exit? Whenever the close is beneath the low of the previous day. So this close is not beneath the low of the previous day, that tiny little red body. So we'd stay in it. We would stay in it. The close is staying above. It's gapping down but closing up. And on this day, we would exit where we have that big red engulfing candle. So we'd enter in here at this price point of, we'll say 171, and we would exit out a few days later at like 176. About a $5 price point move. This could literally mean hundreds of dollars depending on your position. And then using our trend lines, we'd follow through. It's now retracing or resting, and then we're looking for another another entry to the upside. It closed above the 10-day simple moving average. We'd wait for confirmation. Sure enough, we'd hold in this thing until it breaks beneath the 10-day simple moving average, which would be right around here, or the low closes beneath the price closes beneath the low of the previous day. So we've got that. This is an established bull momentum breakout trend, and we could trade this thing all day long. We could trade this thing all day long, realizing that it's likely going to use the 50-day simple moving average as a support, and then once it crosses above that 10-day simple moving average, we'd wait for confirmation, trade it, use the aggressive exit, or use the 10-day closing beneath the 10-day moving average as a less aggressive exit and make money. Now, whenever this price closes beneath the 50-day simple moving average, that is some cause for concern for us. So at this point, once it closed beneath the low, once it closed beneath the 50-day simple moving average and continued down, it now creates a bearish momentum breakout, and we don't see it end until the price closes above the 10-day, which is right here on that day, right there on January 1st. And it would look something like that. Boom. So could you make money here to a downward play? Enter here on this date and exit out, maybe not at the exact bottom, but right about here when it closed above the 10-day simple moving average. You absolutely could. And then once it closed above that 10-day simple moving average, we would wait for confirmation for the 10 to close above the 20, which would be here on this day, and then a continuation, and this would now be a bullish entry point. So the 10 closing, the price is above the 10-day simple moving average, then the 10 simple moving average moves above the 20, and then we have confirmation, which would be here on this day. And we would and this would be a little bit of a bullish momentum breakout, and currently this thing is in a bullish momentum breakout phase. Now, could you say that the bullish momentum breakout started back here whenever it closed? You could, but we didn't have our confirmation for signal for entry until this point, once the price was above the 10-day simple moving average, above the 50-day simple moving average, and that trigger of the 10-day simple moving average moving above the 20. Then we have a close price above the top of that candle. That was right here on this day, and it gave us signal for entry. So that, guys, that's QQQ. Let's look at SPY. And this is a one-year chart. So let's do a little bit of consolidation. You might say, Tim, how do you recognize consolidation? Consolidation is oftentimes whenever it's just flirting around the 50-day simple moving average, and it's channeling. You'll see maybe a double top or triple top, or a double bottom or triple bottom. It's not till it breaks the double top or a double bottom that it generally will break out into a direction. But you can think of consolidation kind of like a tug of war, and it's just moving right around the 50-day simple moving average. So we have it here to here. It's maybe right around this price point. That's consolidation. And then once it breaks beneath that low of the consolidation period, we have a short-lived bearish momentum breakout, which is right here. And then we would be looking for a price close above the 10-day simple moving average, which would be on that big giant. Let's see if we can't zoom in a little bit. On that big giant green day right here, close above the 10-day, and that's our exit. Then we enter into another consolidation period, meaning that it's just tug of war. It's going nowhere really from here to here. We enter into a consolidation period, and then it's just going up, down. It's flirting around the 50-day. There's no real price direction happening. There is a high, and then it can't break it, and it can't break the previous lows of that big candle body, and it's just floating around. It's not until we see the price point close above it's above the 10, the 20, and above the 50-day. Then we see a confirmation, and we have a continued move to the upside, and then we have our bullish breakout. And so let's chart that out. Bullish breakout. When the price point closes above the 10, the 20, and the 50, and then there's confirmation. Over here, this happened. It closed above the 10, the 20, and the 50-day simple moving average, but there wasn't any confirmation. The next day was a red candle body, then it retraced. But this day, we have it closing above the 10, the 20, and the 50, and confirmation. So that shows us that that is our breakout point, and we have a bullish momentum breakout for that's May, for about 5 months here. This thing continues up. It comes down to about the 20-day simple moving average. It rallies again. It comes down to the lower 50-day simple moving average. It rallies all through using the 10-day and the 20-day, and then it continues to use the 10 and the 20-day, and it's not until we get over here, which is a lot like the QQQ, when it breaks below the 50-day simple moving average, that we then have a trend reversal with confirmation that it continued to move lower. 50 pretty much uses the 50 all the way until closes above right about here on this day. This would be considered a bearish momentum breakout, where the price closed beneath the 50, we have confirmation, and then it uses that 10-day simple moving average as resistance. It breaks above it. We would exit out at this point using our trade plan because it closed above the 10-day simple moving average. It rallies up to that 50, and then we know that oftentimes it uses the 50-day simple moving average as resistance or support. In this case, since it's below it, we expect it to use as resistance. What does it do? It comes up to it. We'd be waiting for it to bounce down, and then sure enough, on this day it bounces down, and then it continues down. That would be a sign for entry to the downside. We'd ride it all the way down until the price point closes above the above the 10-day simple moving average for a less aggressive exit right there. We would then wait. It would go expecting it to reclimb back to the 50-day simple moving average. Then we'd wait for confirmation of it to continue to move down. It does. We use that. We say, yes, it's hit the 50-day simple moving average to move down. We would enter in here. We would ride this thing all the way down until it closes above the 10-day simple moving average. We would make money all along the way. Now, we essentially have a bullish momentum breakout whenever the price closes above the 10-day simple moving average. That gives us our first step that this thing is maybe a trend is reversing, but we're going to wait for confirmation of the 10-day simple moving average to widen and close above the 20-day. At that point, that's our candle for entry, and we need a candle above the high of that day, and then we would look for it. So let's look. So here's the price above the 10-day simple moving average. This could be a sign that, hey, things are beginning to change. And then a few days later, maybe about a week and a half later, we have the 10-day blue line close above the 20-day, and then we would wait for a confirmation of a price closing above it. This would be our entry. If we use an aggressive exit, we would exit the very next day, take a small loss. If we use a less aggressive exit, we would still be in this trade because it hasn't closed beneath the 10-day simple moving average. So a bullish momentum breakout would be, again, the price closed above the 10-day simple moving average, but we don't have confirmation until the 10 closes above the 20-day simple moving average, and then we have a bullish momentum breakout. Now let's zoom out a little bit. I want you to tell me what's the difference between a bullish momentum breakout and a bearish momentum breakout. Can you see anything different between the green boxes and the red boxes? Yes, I hope that you came to the same conclusion, that bullish momentum breakouts trade in a shorter range. The reason why is that there's not, whenever things are bullish, volatility is lower in the market. So we don't have these huge swings. However, when things are bearish, volatility comes into the market, so we have these big red days. So it creates a smaller channel because there's less volatility for a bull momentum breakout, but there's a wider channel for a bearish momentum breakout because of volatility and larger swings. There's generally always larger swings to the downside than there is to the upside. That's why people make money in down markets very quickly. There was a lot of money to be made here in this market. However, you can we're historically in bull markets more than we're in bear markets. So you need to know how to trade both. But that's the SPY. Let's go on to, we did QQQ, we did SPY. We could do DIA, but let's go do a chart off. Let's go look at Johnson & Johnson. So I'm going to remove some old drawings. I haven't looked at this chart in decades, not decades, a long time, lots of weeks. I haven't looked at this charts in lots of weeks, but let's look at it. So a year back, it was in a bearish momentum. It was under the 50 using the 50-day simple moving average. So let's draw that out. Bearish. So it's under the 50. Let's just start it because I'm not going to go back and look to the left of this chart because we're just looking at it 1 year's worth of time. But let's start the bearish momentum breakout whenever we have the come up to the 50 and then the continued drop down. So it'd be somewhere like here. And then whenever this thing closes above that 50-day simple moving average and continues to move up, that would be the end of that bearish sign. So there's the bearish of it, the bearish momentum breakout, and then let's chart out that bullish momentum breakout. Where are we? So we have the price close above the 50-day simple moving average, then we have continuation, then we have the 10-day closing above the 20-day. We would enter in here on this candle body right here. Let's see if I can't zoom in a little bit to that. So we have the 10-day close above the 20-day, that blue line above the 20, green line. And then we would wait for a close price above the high of that day, which would be here. An aggressive exit, we would lose money. Even a non-aggressive exit, we'd lose money. We would wait for it to come down, looking for a 20-day or a 50-day, come down to one of those supports and then bounce higher. It, in this case, only used the 20-day simple moving average, and then it begins to move up. That would be our entry. It comes down to the 20-day and then it moves up. This would be our entry right here, and we would ride this thing all the way out to here, and we'll talk about that here in a moment. We'd ride this thing all the way out till it closes beneath the 10-day, and then it closes beneath the 20-day, and then it begins to go sideways and consolidate. Really, it's consolidating through here, but we'd hold on through it because it hasn't broken our rule yet, which is closed beneath the 10-day simple moving average. It would have here, so let's adjust that. It did close beneath the 10-day simple moving average on this day here. And then we enter into consolidation where it's just flirting. So once a trend breaks, so if you're using less aggressive, that would be it closing beneath the 10-day simple moving average. This is important to note. Once a trend breaks and you're exited out of that position, you want one of two things to happen. If it's a bullish trade, you want it to come down to either the 20-day simple moving average, hit it and bounce, or come down to the 50-day simple moving average, hit it and bounce higher. That's what would be for a bullish. And then for the bearish is the same. Once you're exited, you're triggered to exit. Let's say it closed, above in a bearish. If it closed above the 10-day simple moving average, that would signal you to exit it. You're then waiting for it to hit a 20-day simple moving average and then continue downward, or a 50-day simple moving average. Remember that the stronger the momentum of the trend is, it uses the shorter time period, like a 10-day or a 20-day simple moving average. Now, if momentum is coming out of a trend, it's going to use a longer time period, like a 50 or maybe even a 100-day. But we're looking at those common time frames for points of support if we're in a bullish trade, or points of resistance if we're in a bearish trade. And then once that happens, it hits that point and bounces, then we look for confirmation, and that's another entry point. So, okay, consolidation, we see that it closes beneath the 10, and then it just flirts right in with that 20, and then it even drops below the 50, and then it has a big move to the downside, but no confirmation to the downside. Then what actually happens is it reverses and continues to consolidate within the price period that it was consolidating here. It's not till we have the big up day and then a little bit more consolidation, and then once we have these days that the market continues to move to the upside. So let's see. Oops. Delete that. Let's come back into full picture here. Draw that out right about there. Consolidation, and then as the price closes above the 10-day, breaks out of the consolidation period, we're now looking for confirmation, which there's not much confirmation until this day where we continue to break to the upside. That confirms that the trend is reestablished and it's breaking to the upside. And then we have a massive drop here on this day, and that invokes another trend, it closing beneath the 50, and then continuation to the downside. That invokes a sharp bearish momentum breakout, where the price closes to there. So now I waited until the price closed above the 10-day simple moving average right there, and then it just moved sideways, and it's been moving sideways for pretty much all the time, even until now. It did break above the channel here, but what happened? It threw a long wick, stayed under the 50, and then it's just been flirting. So really this past period, looking at this chart, has been in consolidation period from this day until current day. It's slowly climbing, but even then, look at the long wick here, which is the top of this channel, and then today it throws another long wick, can't get above the top of that channel. So once this thing closes above the top of this wick, that would be a confirmation. So Johnson & Johnson is on the verge of breaking out into a bullish momentum play. And if we saw this thing close above its current wick, and since the price is above the 50, it's above the 20, it's above the 10, that could be a sign of entry of it breaking out of consolidation into a bullish momentum play. Now, that's all I've got for you. I hope that this adds some value. The only way that you are going to get better at recognizing market trend cycles is by simply doing it yourself. The first giveaway is whenever the price of the underlying security for a bullish closes above the 10-day simple moving average, then you wait till the 10-day simple moving average is above the 20-day simple moving average, and then you wait for the high, the price to close above the high of that signaled entry. And once that happens, you have an entry. And then once you have an exit, which an aggressive exit is that the price closes beneath the low of the previous candle body, or less aggressive is whenever the price closes beneath the 10-day simple moving average. That would signal you to exit that trade on a bullish trade plan. Then we'd wait for it to come down to the 20-day simple moving average, and then if it continues through the 20-day simple moving average, we then look to the 50-day simple moving average, and we're waiting for a bounce, meaning that it comes to one of those averages, hits it, and then continues up. If it continues up, we have that confirmation of it bouncing, then that is a continuation into that trend. We would re-enter and follow our exit plan of an aggressive exit or less aggressive, and we could do this over and over and over inside of a trend as long as it's happening. Once the trend breaks, if you're in a bullish trend and the price closes beneath the 10-day simple moving average, then it continues down to the 20, continues down to the 50, and then the price closes beneath the 50-day simple moving average, and you have confirmation the next day it continues lower. That is a trend reversal. It's just the opposite for a bearish, just put everything in reverse. But guys, just put this into practice. So if you want to know more about everything that I'm sharing with you, you might be interested in my technical analysis course. You can find out more information about it by going to optionlegacy.com. I would love to empower you with knowledge so that you can build a legacy through trading. So till then, guys, I hope you enjoyed this bonus video. I'll see you next time. Let's build that legacy.